All right, I'm Jason from Yarusi Holdings, a multifamily investment firm here in Nashville, Tennessee, a submarket called Murfreesboro, Tennessee. We actively invest in multifamily projects across a couple select markets, including Nashville, Atlanta, and Louisville. Currently, we have about 160 million of assets under management with another 50 million in the pipeline. Today, we're going to talk about structuring your investment. And we can do this a number of ways. Today, I'm going to talk to you how we do it in a syndication. With the syndication is where we actually pool resources from others, from investors, and from ourselves to be able to benefit from buying larger properties because it gives us the benefit of scale. With that said, we use a LLC, and that LLC is just for the asset we're purchasing. And within that LLC, we have the general partners and the limited partners. The general partners serve as myself and others who actively manage the project, where the passive investors are solely investors that are looking for a return from their investment but do not have any active capacity for their investments. But is that the only way? No. There's other ways as well. You can have a straight partnership, and that partnership may be a number of active members who go and buy the project themselves and handle the various roles. And that could be anything from finding the lead to being able to sign on the debt and having the balance sheet for that, to providing the capital, to being one of the members that underwrites or does the due diligence or does the asset management, right? So you can structure that. But what are a few other layers you can put in there? Well, there are ways to offer select equity classes, because with our syndication, where we have our active and passive partners, we bring equity in, we put debt in the property. We use leverage to our advantage because it helps us really bring down our return, our cost of capital, because the debt is typically a cheaper option for a majority of project to keep within a good balance of leverage than bringing on full equity for the project. So within that, we'll bring on debt. It could be anywhere from 60 to 80% of the leverage for the property, with the equity serving to provide the other amounts on the project, including potentially the construction. We also may add in a layer of preferred equity. Preferred equity typically are equity members who will come and invest, and they will basically be the first one after the debt to be paid. They will be paid in sequence here, where they're going to get a straight return and have no part of the upside. However, they will have the preference on the return for the equity. So the other investors, we'll call them common equity here, will have the potential to receive the coupon, right? The continued rate of return that may be the preferred return. However, they will also benefit from the upside. So the consistency for the preferred return is they may have a lower overall return for the scope or for the course of the project. However, they will be able to benefit from being first in the stack above the common equity. The common equity may get a greater return, but they're going to be last out for the return. So they both will invest together at the same closing start. And we could say that potentially, if it's $1 million investment, with that, including the capex or the construction of it, we may have, say, 65% of that coming from the debt. So $650,000 will be the debt or the loan, and then we may have $100,000 coming from preferred equity, and the remaining $250,000 coming from common equity. So as the investment will go, operations will consist to be able to pay the debt service, which will provide the cash flow, and then the cash flow will pay out the preferred equity first. And once that payout rate has been met, say every $100,000 there is an 8% preferred equity rate, well, we would have to meet cash flow to sustain to be able to pay out that 8% to preferred equity before there would be any payout to the common equity. Past that, the common equity would have their split not only for their preferred rate, but also now have upside beyond for any of the profit from the deal. So there's various ways to structure it, and the reasons why they'll use preferred equity is preferred equity gives those members more consistency and really the driver to have first in of the returns, but it will also bring the cost of capital down for the investment partners, for the partners, general partners putting together the deal. There's also other ways to structure the equity, where you will do an equity and debt structure, but the equity will have preference on returns based on how much the investment is. If you do solely $100,000 or less as a passive investor, maybe you get a 6% preferred return, where if you do $250,000 or less, you get a 7%. $500,000 $500,000 or less, you get a 8% return, and a million or up, you get a 9% return. Or you could do it where you give them more percentage of the equity holding. So noting that there can be many options here for you to go forward and structure your investment to be able to make it benefit not only yourself, your investors, but also the project. But I put out the caution: do not make it so complicated that the investor who is looking to be able to invest, even if they like you, that they'll stand on the sideline because it's too complicated for them to understand. Make it simple so they can make sure they're making a great investment decision, but it can also benefit you to be able to get your raise done in an appropriate manner. Again, I am Jason Yarusi of Yarusi Holdings. Thank you so much for joining us for today's webinar. If you want more videos like this, make sure to subscribe to our YouTube channel so you can definitely be noticed when more of these come out. Thank you again. Let's do this.